Our next speaker is Richard Lehman. He's a PhD and author, instructor at the UC Berkeley. He has one of the more intriguing titles we've ever had, and that is, for his topic is to improve investment performance, ditch your emotions, instincts, and overconfidence. So on that, we probably have all felt some of those feelings, especially during the bear market and the volatility and the exciting times that we live in. But anyway, Richard Lehman teaches behavioral finance at UC Berkeley Extension and real estate finance at UCLA Extension. He is also an author of 3 books on investor behavior and option strategies. Richard previously worked at Wall Street for several investment firms and at the New York Stock Exchange. His latest efforts includes a 4th book and the founding of a startup, Informed Asset PBC, a company that provides information and education on alternative assets and private market investments. And I'll give you his three bullet points because I think they're informative of what we're going to be covering. And they are: 1, how much individuals underperform the market averages. Number 2, what the key behavioral factors are that hinder investment performance. And 3rd, how investors can begin to improve their performance by addressing these behaviors. We've all had a course through this bear market and emotions of investing. So I'm looking forward to this presentation. And Richard, you have the floor.
Thanks, Lynn. Good morning, everybody. Since we're going to be talking about emotions, if anybody wants to address the 800-pound gorilla in the room called Silicon Valley Bank and express some of that emotion, I understand you haven't really discussed it yet. Any comments from anybody out there to kick this off?
You can put those on chat, or if somebody wants to unmute themselves and just ask it directly, that's fine.
I figured this one really hits home. Talk about idiosyncratic risk. Who would have thunk, right? I've always been very impressed with Silicon Valley Bank, and I have a startup, and have talked to them, have heard their pitches. I was always very impressed with everybody who worked there. Who knew? And I find it really fascinating as a lot of the pieces of the puzzle get uncovered, that it really, it really wasn't so much, and maybe this isn't the full information yet, but it doesn't seem that it was because they were lending to startups that they failed. It looked like more sort of banking 101 stuff. I see somebody mention that. And the fact that 93% of the funds were uninsured kind of blows my mind. So more of this story, I'm sure, to unfold. And I hope that nobody in the audience was stung too bad by it. We can come back to this, but let's get into the meat of what I came to talk about. I'm going to break this down into about 5 subtopics. The first one is what causes behavioral biases. Okay, condensed version of my course. What's their impact on us? If there isn't much impact and it was trivial, then why bother learning all that stuff? The point is, it's not trivial. What are the worst things we do as investors? That's actually a really long list, but I'll try to condense it for you today. Is there any hope for us? Yes, there is hope. There are things you can do. I'm going to give you a slew of ideas. They involve some effort, some work, almost no money, actually, and they're there for the taking. So, yes, there are solutions. So let me start out by just making this statement. Attention, everybody. The person you rely on to handle your investments Yep, the person you believe you know better than anyone else on the planet. Yes, the person you entrust all your hard-earned money to. Yes, the one you have the highest amount of confidence in is ill-equipped to do the job. That's the reality. It doesn't mean they absolutely can't. It just means they're not going to be the best at it and probably not as good at it as you think. And that's where the issue lies. And why is that? Because the person who's managing your money is human. And humans are plagued with behavioral biases. And that's not such that it's only individuals, because professional advisors, professional traders, hedge fund managers, they're all human. And guess what? They all exhibit the same biases, although the professionals have some advantages and they're able to, mediate some of their biases. Number one, they use computers, gets rid of a lot of the human emotion. Number two, they have staffs of people that they work with to be alter egos and do research and things that you don't have the luxury of doing. So yes, they're human, but they have tools that they use to get around their humanness and perform better than we can as individuals. So why is it that humans really aren't suited to skillful investing? It really boils down to our decision process. If you understand what goes on in a human brain to make a decision, you'll get a big clue as to, why we're not good at certain things, one of which is investing. There really are three main sources of biases. Okay, one is emotions. We all know what emotions are. There's a whole lot of emotions directly associated with the kinds of risks we take in the financial world. Overconfidence, one of the biggies. But we experience fear, regret, doubt, pain of loss, more common things like familiarity, and these all impact decisions. Emotions are an essential part of decision-making for humans, regardless of the weight of the decision, the type of decision, or anything else about it. You wake up in the morning and decide what you want to have for breakfast. There's an emotional component to that question. You decide what college you're going to go to, who you're going to marry, or what house you're going to buy, or what investment you're going to make. It also enters into it, and a lot more than you think. The critical issue is we're born with these emotions. We weren't taught them. They're innate to humans, so they're always there. And we can't control them as much as we would like to think we can. We might control some of the behaviors we do as a result, but we're going to feel emotion anyway. And that emotion, those emotions get into literally every decision that we make. A second whole area separate from emotions has to do with what the field calls heuristics. Heuristics are the ways your brain operates, the mechanics of how a brain makes a decision, which is not unlike the mechanics of how a computer makes a decision. Computers use some kind of algorithm. All right, they look for information to see if they have it. They have short-term memories and long-term memories. They're taught by programming to use certain information and not use other information. And our brains work basically the same way. So there are a number of heuristics listed here, which we could talk about a few of them, but basically it has to do with the way the brain deals with information. And the overall mainstay of heuristics is the fact that our brain takes shortcuts. Thinking is work for the human body. The brain actually takes about 25% of our energy needs, which you wouldn't think, but it does. And it's because thinking is work. And hard thinking is hard work. So our thinking process gets shortcutted naturally. We try to make quick decisions, and we're actually pretty good at making quick decisions. But to do so, we take shortcuts. And if you have to make a really, really quick decision, like the stock is plummeting or that opportunity is getting away from you and you're about to press the button to throw a whole lot of money on the table, we really shortcut those decisions. And there's usually, or pretty much, probably 90% of the time, an emotion that's behind making that decision, as opposed to the kind of rationale and logic that we would like to think is behind that decision. And the third thing is that, surprise, surprise, we're not really good at math and statistics. And markets and uncertainty is all about statistics. It's all about probability. And we're not good at that. Computers are better. And the professionals who use computers do a lot better at assessing statistical probabilities and using math to come up with solutions than we are when we try to do them in our heads. We don't understand the laws of chance. We don't understand the difference between something that happens on a random basis and something that happens for a reason. And that's pretty darn important in terms of understanding how markets move. So, we have some distorted views about probabilities. We have some distorted views about gambling and taking risk. And that enters into our decisions about finance. So between the emotions, the heuristics, and our inability at math and statistics, we've got a lot of headwinds that affect our emotions. And it's definitely non-trivial. You can take any one of these things, and this is not a complete list, by the way. There's about 15 or so here. I teach about 25 in my course, and depending on who you read, you could invent as many as 100 or 200 of these things. And yes, at some point they do get somewhat more trivial, but the point is they're all there. So we're not dealing only with one or two emotions or one heuristic. We're dealing with a bunch, and so they compound each other. And when they compound each other, they are definitely non-trivial, and they affect us in a way that we don't immediately see, we don't immediately feel, we don't immediately understand. And the impact is pretty substantial. We'll talk about that in a minute. So all our decisions are subject to biases and heuristics because it's a basic part of how brains work. We can't shut that stuff off. They're not trivial, especially when they work together. They are pervasive, meaning we all basically experience them, all humans to some degree or another. Now, there are differences in the way some of us feel them. There's differences of degree. If you really get down into the details of behavioral science, you'll learn that there's cultural differences, there's gender differences, there's differences between age groups and generations. But basically, it all comes back to being that we are all human, and we all, in one way or another, suffer from all those things that I just put out there. Another thing to recognize is that these things are hardwired, meaning they came with us. They're part of our operating system. We were born with them. This is not stuff you learned as a child or learned in school. This is stuff that's innate. It comes from evolution. So you can actually track these things back to when humans lived on the savannah and everything related to survival. The reason we think fast and we make fast decisions is because that's what it took to stay alive back then. You didn't make a fast decision, you were someone's dinner. And your genes didn't get into the gene pool. So evolutionarily, this is the way our minds developed over time. And we still relate to the genetics of all these things in current day time that really are a function of survival back in the early days of humandom. Also, they're subliminal. We don't have conscious awareness of them. Now, I can talk about them and you can say, oh, yeah, I do that. You know, I do think that way. Yes, I have made decisions like that after the fact, but in the moment when you're making a decision, you are completely out of conscious awareness that a lot of these things are having an effect, which is what makes them so kind of sinister. Also, we tend to deny them. You know, there's a lot of overconfidence in people, and we tend to deny that we have all these flaws in the way we think. We think we're pretty darn smart. And, you know, compared to other species, we are, but compared to perfection, you know, we're not there yet. And when you look at the history of mankind, how much of mankind's history had to do with finance and investing, you know, one weensy part of it, right? Last couple of 100 years. Before that, you know, forget it. And then, you know, so you got 1 million years of human history, and only the last couple of hundred had to do with things like finance and computers and investing. So there's a lot of overconfidence out there. We are taught confidence. We are pushed by our parents, by our teachers to have confidence. Confidence is a good thing, but overconfidence can be a hindrance. And finally, our decision process, as it were, is extremely difficult to change because we're born with it, because it comes from evolution. It would take a lot of work to change that system, to alter it in some way. But we can deal with it. We just can't change our behavior. We can't change our emotions. We can deal with them, however, and you know, I'll give you a lot of tips on how you can do that in this presentation. So we can mitigate the effects. That's one way we can approach it. We can work around our emotions. That's actually a pretty common way. You know, you find out, well, I have a big emotion about this. Work around it somehow. You know, avoid the stimulus. Do something different. So sometimes we can just avoid them. I used to have a lot of road rage when I commuted, and there were certain places that I drove where people would constantly come in and cut me off, and I'd just get super angry and it wrecked my day. So what do? Change the path I take to work. You know, take a different road. Take something that has better scenery where you don't notice people cutting you off, or they don't cut you off. And that was the solution. You know, I wasn't going to change my behavior. I wasn't going to change the fact that I was going to get mad every time somebody did that. What I could change was the path I took. And some of these things we can actually turn to advantages. So they're not all bad. So what's their impact on us? Well, they cause us to make flawed investment decisions. Over time, this is obviously going to affect performance to the negative. And that's year after year after year. The thing about making investment decisions is when you think about that versus making a single big decision, like, you know, where are we going to live and what house am I going to buy? Okay. That may only happen once, 2 or 3 times in your whole life. The decision to invest is a continuous decision for years and years and years of your adult life. You start probably in your 20s when you start having some money from the income from a job, and you don't stop in many cases until you're gone. That's a long time to invest. That's a lot of different investment decisions over time. So a decision that you repeat over and over and over again, year after year, A, is going to have a lot more impact on you, you know, and B, becomes more dependent on process. So how you make a single decision, like what college do I go to, really is a different process and needs to be a different process than a decision you're going to make over and over and over again for decades, right? Which has to have a lot more discipline and a lot more process. So here are some actual headlines from places you might be familiar with, which talk about this problem and how it affects performance. Every year, a company named Dalbar does a study, basically of people who own mutual funds. And every year, almost without interruption, you get headlines like this when the study comes out. It's like, Americans are still terrible at investing. The annual study again shows. Well, when they take their study every year, that's pretty much what it does show. It's just a question of how much. Did we get worse than last year or better? Here's another one. Investor returns versus market returns, the failure endures. And my personal favorite, let's face it, you suck at investing. Happy New Year. Try to suck a little bit less next year. These are real headlines. So what are we talking about here? How big is it? How much worse than the market averages does the average individual perform? Are we 0.5% off the mark? Are we as much as 2% off the mark? You ready for the number? That's the Dalbar number. On average, over 30 years. That is a per year number. Think about that. If you're underperforming by 6% per year, you're doing some serious damage to yourself. All right. And that's an average. Yes, there are people that probably do a whole lot worse. There are certainly people who do better. There are people who can avoid losing 6% to the market averages. It doesn't mean you go down 6% every year. It just means if the market does 12, you're doing 6. That's a serious impediment. So it's not trivial. Any one of the 20 or 30 biases that affect you may only affect a little bit of that and contribute, a fraction of a percent. But when you start adding it up, it's a big number. And add that up over decades, big number. So here's the chart from Dalbar. This is last year's. I didn't catch what the latest number is, but it's not going to be a whole lot different. There were some years and some 5 and 10 year periods where it was down as low as maybe only 3% below the market average. Okay, so if you want to just latch on to a range instead of a fixed number, say it's somewhere between 3 and 6% on average over the last 30 or so years. But it does get worse. There were a couple of academic studies which looked a little bit deeper. One was a study by a Berkeley professor and a UC Davis professor back in the 90s called the Schwab study. Big study, cited very, very often in the industry. They looked at over 60,000 Schwab accounts over a 5-year period. Now, Schwab accounts means they're looking at people who are trading stocks, not just mutual funds. So now it's more people like yourselves. Net returns for all investors, about 2.5% below the average annually. So not very far off from what Dalbar says. Net returns for the 20% of people who trade most frequently, down 7%. Obviously, the more turnover, the lower the return. Trading doesn't help, it hurts. And because of that, since women trade less often than men, women outperform about 1%. The authors of the study came out with their statement saying the average household, and you're going to relate to this, tilts its common stock investments towards high beta, small cap, value stocks and turns over about 75% of its portfolio annually. What is that? It's overconfidence. It's thinking you know more than what's going on in the market and that you can do better and that you can time things. And unfortunately, it's dragging you down. Another study was conducted in Europe, but by a Santa Clara University professor in part. And it was conducted in the Netherlands a little bit more recently in 2015, using data from the early 2000s with a major online broker in the Netherlands. A little bit smaller study, but basically along the same lines. All investors down 1%. Investors who use technical analysis, because they ask the question, down 8.6%. That means if you're using charts, which you think, and I think, is a great tool, you're certainly not using them effectively. It gets a little worse. They asked people if they trade options. You can pretty much guess where this is going, okay? 20% below the average if you trade options. What does that mean? It means a huge amount of the people who trade options just burn themselves out, literally. When I gave this talk a couple of years ago and cited this study at a professional meeting at the CMT Association in New York, I had a VP come up to me after the talk, the VP of a discount brokerage firm. And he said, you know something, those numbers actually are what we were experiencing. And he says, it's really tough because in the options world, we know that when people come in and start trading options, we can expect that we're going to have them for about 7 to 9 months. Then that's it. They're gone. They burn themselves out. Now, that doesn't mean all option strategies are bad. It doesn't mean all chart strategies are bad, but it certainly indicates that as a public, we're not using them well. So an interesting kind of follow-up to all this was a Fidelity report that hit the news one time. And if you dug into it, you realize that the subgroup of Fidelity investors with the highest returns, people who forgot they had an account, and deceased account holders. In other words, don't do anything. You'll end up doing better than the average person who thinks they can do better and tries to trade. All right, so what are the worst things we do as investors? I'm just going to give you a bunch of them. It's a long list, right? But you're going to relate to a lot of these, I can guarantee. One, we jump to quick conclusions based on too little data, i.e. news. We see news or we see something happening in price action itself, and we jump to a conclusion. That must be where things are going. What really gets me is watching the Fed announcements and watching anytime Powell makes a speech or there's some other data point coming out on inflation, and watching what happens in the market. And almost more often than not, the market doesn't know what to do. It takes a wrong direction initially, and then changes its mind and goes the other way. Why is that? Because the decisions that are being made instantaneously are not coming from people reading the news and thinking about it. They're coming from bots. They're coming from automated, computer-driven algorithms that are trained and programmed to read news headlines or listen to speeches, and based on that, call out keywords and attempt to come to a decision faster than humans can about what the implication is. Is it good news or is it bad news? And then they're trained to actually do trades. And all that happens in seconds. So if you watch market action after these major announcements, within seconds, the market starts to move, and it's mind-boggling. Like, how can they know? I mean, Powell just opened up his speech the other day and the market started to move. It's like he hadn't really said anything yet, right? That's because the first few words out of his mouth are already being parsed by some computer somewhere that's making a trade on it. But guess what? In many cases, they guess wrong initially. And later on, as they get more language and they get more information, they go the other way. So if you're watching those first minutes of trading after a major announcement, you could very easily get misled in the complete wrong direction. We're also highly influenced by what others think and do. We're easily swayed. Now, part of that is our need, well, it's called herding, and part of it is our need for information and our need to tap the expertise of people who should know what they're doing, but we go way further than that. And we listen to people that don't have the expertise. We listen to a lot of people in the media who are there just to literally fill space or have an agenda that may not be the same as our agenda. And that's bad. And I'll address that more because I think that's a really big item. The fact that we're influenced by so many other people, some of which are good and some of which we may pay for advice for, some of which may be an advisor or a good newsletter, but a lot of which is also junk and misleading. 3, we naively assume everything we see and hear is factual and unbiased. You know, we know where that's going. 4, we overreact to new information. We project things. And we have, as a result, a very difficult time distinguishing a trend from noise. What happens minute to minute, what happens even day to day in the market is noise. And I'll show you some charts later to kind of point that out. 5, we lose our objectivity once we own something. This is an interesting and very subtle thing. Once you buy a stock and you are long and it's sitting in your account, you covet it. You think differently about it. It's no different than when you go to sell your house, right? You lived in a house for 10 or 15 years, you put sweat equity into it, you got all these experiences and emotions attached to it, then you go to sell it, and you always want more than what the market's willing to pay for it, okay? That's because it's worth more to you than it's worth to the market. That's this point, the fact that we lose our objectivity once we own something, and it happens with stocks. Once you own a stock, you are committed to it. You made a decision, you convinced yourself it was the right thing to own, and you lose your objectivity. So if things start to go bad, what do? You hang with it, which is not always the best policy. We mistakenly think that we see repeatable patterns in random data. This is that notion that we don't do statistics well, which means we also don't do charts really well. Even though charts could be a great tool, we don't use them well. And one of the things that is just common to being human is looking and seeing visually, seeing patterns where they don't really exist. We tend to complete a pattern. So if you see part of a chart, your brain tends naturally, without you saying or doing anything, tends to want to finish that pattern in some way. And how your brain's getting that information, who knows? It may be thinking about some pattern it saw in something else that's totally irrelevant. So our brains make that stuff up. It's like when you start a sentence and somebody hears the first few words and thinks that they can finish the sentence. Sometimes they're going to be right. Many times they're going to be wrong. We do the same thing visually. When we look at charts, we tend to extrapolate the pattern without the statistical verification that we're doing it right. And then we trade based on that. 7, we rely too much on recent information and we don't seek older information. That's another very common way that humans deal with information. You know, our brains have short-term memory and long-term memory, just like computers. And we favor the short-term memory. We always have the sense that short-term things are more relevant, more important. If it's older, get rid of it. And that's the way our brains work, right? We're not going to change that. So when we make a decision, automatically our decision process goes to the more recent information. And it doesn't get what I call the big picture. The big picture is going a lot further back, getting a lot more data. And again, we'll talk about this some more with regards to looking at charts. 8, we misinterpret or we simply don't want to accept statistically sound facts. I mean, you know, you don't have to look at too many things beyond COVID vaccinations to understand this problem. Okay. When people get a strong belief from whatever, from a guru that said something, from that they believe in, from an experience, from their own belief garnered from who knows where, all the science you put in front of them isn't going to change their mind. And we know that about climate change also. And a huge number of people that suffer from this problem, they believe that their beliefs are stronger than scientific based evidence. That doesn't help. 9, a common one, we exit winners too soon, hold losers too long. Part of that was the problem I mentioned before about not being objective once you own something. So we'll have something that goes up a little and we'll say, wow, you know, let's just grab this little bit of profit now, you know, and run with it. And at least we can book a profit. Feels good to book a profit, even a small one, right? But the problem is more on the other side. We hold the losers too long because of loss aversion. We don't want to book a loss. That's a very uncomfortable feeling. It's, in psych terms, twice as uncomfortable as the same gain would be on the comfort side. So pain of loss is greater than the elation of gain. And because of that, we hold all losers too long. We think, well, you know, it'll come back. Common thing to do is say, well, it gets back to even, I'll sell it. But then, of course, you don't, because then it's moving back up. And then you think, oh, maybe it's finally moving up. There's a way to address that that I always suggest to people. And that is, you got a stock that you own that's down and you're asking yourself, should I hold it or what? Okay. Ask yourself the question, would I buy it here if I didn't own it? And if you ask that question and your answer comes back, hell no, this is a terrible stock, then sell it. You know, you just answered your own question, but you got to ask the question before you can answer it. All right, number 10, we take additional risks to avoid booking a loss. That's also part of loss aversion. We really don't like taking losses, big time. It's final. It hurts. And to avoid it, we'll take additional risk. One aspect of that is holding on to something that we don't like. That's taking additional risk. The other thing is buying more, taking additional risk. Be careful about that one. That one gets a lot of us. 11, we over-concentrate portfolios and trade too frequently. Well, you saw the statistics on that from the studies. Most of us are way over-concentrated in our portfolios, and we trade much too frequently. From a concentration point of view, you can go to classic finance theory. if you want to get rid of most of the idiosyncratic risks, which are the risks of holding any one instrument and having it blow up like Silicon Valley Bank, then you need to own at least 20 or 25 different things. That's why the average mutual fund holds 100 to 200 different things. And they better not be all the same thing or all the same class, because then you're fooling yourself if you think you're really getting diversification. We way over concentrate portfolios. My daughter's a financial planner in the Bay Area and deals with high net worth people, and almost all of her high net worth clients are come to her because they made a lot of money in tech stocks and they are way over concentrated, and they don't know what to do about it, because then you get into a position where to sell stuff and diversify, you're going to have a big tax spike. So it's a good problem to have. Yes, you made a lot of money, but if you think you're going to keep making a lot of money, you're fooling yourself. At some point, those stocks also can go on a tear and on the downside, and you lose more as a result. 12, we react differently to the same situation depending on things like our mood, how much sleep we got, what the weather is. They actually have done studies and showed that the market performance on listed stocks actually had a statistical correlation with the weather in New York City. And they've done it in some other places as well. It's small, and you're not going to, don't think to trade on that, but it's there. We're very moody creatures, and we don't make decisions well if we're in a tough mood, if we are aggravated about something or anxious about something. So good thing to recognize. We focus too much on upside potential and too little on downside risk. We're very opportunity oriented. We'll look at, okay, here's 5 stocks, which one's going to make me the most money? We forget that beta works both ways. Things that go up much go down much. And we don't hedge ourselves enough or diversify ourselves enough to hedge against that risk. So we go on the roller coaster. 14, we're often swayed by irrelevant, biased, or misleading information. And that gets back to some of the other ones before about, listening to the media, or looking at charts incorrectly and taking away things that are irrelevant or misleading. And if they're coming from the media, in many cases, they're going to be biased. One thing I would say is, if you're watching YouTube and any of those ads come on about people that made fortunes and here's how you do it, immediately shut that off, right? Biased, bogus, in many cases, totally false. 15, we rely on intuition a lot. This is one that's tough for people to acknowledge, because we all think intuition's a good thing. Go with your gut. If your gut tells you this is, your gut must be smart, right? Well, I haven't looked lately, but for everything I've ever done and seen in the medical universe, there are no brain cells in your gut. There are neurons in your gut, and your gut does talk to your brain. Your gut will say, I'm hungry, go eat something, but your gut doesn't think. What people view as instinct has some really good and some really dangerous properties. Instinct is subconscious skill or subconscious knowledge, let's say. It's not always necessarily skill. If you are a professional at something like an athlete, a professional musician, a craftsman of some kind, you learn a skill and you learn it to the point where it becomes subconscious. You don't have to think about each note you play on the piano anymore. If you're a really good piano player, your subconscious is actually playing the tune. because you've trained yourself. And when you train yourself, it goes into your subconscious. You trained yourself to learn how to drive as a teenager. Now you don't think about it. Now you can drive down the street while having a conversation and talking on your cell phone. You shouldn't, but you do, and you can. The same thing happens with the instincts that we have for investing. We think we have good instincts, but we haven't properly really trained ourselves with those good instincts. If you do, yes, you will get better. But that means you got to train yourself with instincts that are meaningful and productive. And to get there, you have to do a lot of work to make sure you're training yourselves with the right things and that you're not just picking up bad habits. So we rely a lot on intuition, but that is a very dangerous situation because intuition's no smarter than your conscious thinking unless you've trained it to be smarter. 16, we are hugely overconfident, believing none of this applies to us. There's a bit of denial there, but that's the way it is. And yes, our overconfidence, can be an enemy at times, especially when you have a kind of a good run. You make some good trades and you think, oh, I've got this, and then you go taking more and making bad decisions. This is somewhat of a short list. It's a good array of different things, but trust me, there's more. So if you want to sum up from all of that, what are our biggest behavioral flaws about investing? I would say using emotions and instinct instead of good discipline, which involves some science and some process. Secondly, allowing ourselves to be swayed too much by other people, by the media, and by the market price action that we're watching day to day. And the last thing is being overconfident and just thinking, oh yeah, we can do this and we're good at it. When in many cases we're fooling ourselves. So is there any hope? Let me just quickly go up to chat and see. There's a bunch of questions here. All right, there's some SVB stuff. With a diversified portfolio, it is guaranteed that you will underperform the market. How does Dalbar look versus a 60-40? I don't know whether the Dalbar people look at that detail or not, whether they start looking at what kind of portfolios people had. They may have that data. They don't publish it in their summary. You'd probably have to buy their full study to get at it. If you have a diversified portfolio, are you really guaranteed to underperform? Yes, but only by a small amount. I mean, you're guaranteed to let's say you index and you just buy index funds, okay? You're going to underperform by the percentage of the fee inside those index funds or ETFs. So yes, you're going to slightly underperform. But if you buy an index fund over time and you underperform by 50 basis points, let's say, or 25 basis points, that's a lot better than 600 basis points, which is what Dalbar's study was saying. Almost 75 to 80% of trades are algorithmically generated. Yeah, that's what I'm saying. And they're not always right. They deal with the law of large numbers. There's a good book out there about the guy who ran Renaissance Technologies hedge fund. James Simon, I believe was his name. Like The Man Who Beat the Market or something like that. Very interesting book because he was a very interesting character. His hedge fund minted money and still does, but they closed it out to the public years ago and they only make money for themselves now. He was a mathematician, pure and simple. He was a quant. He was a geek, and a very good one. And the entire modus operandi of Renaissance technologies was algorithmic. It's go look at tons and tons and tons of past data, let the computer come back, not human, let the computer come back and tell us, what did it find? Did it find anything you could trade on? And then letting it do it. And he was asked what percentage of his trades are profitable. And you might think he's gonna come back and say like 85 or 90%. 54%. With all of that, 54% of his trades are profitable. He loses on 46%. But that's kind of the same numbers as a casino. You know, they have maybe a 3 or 4% VIG that is their profit. But if you do it over and over and over again every day on lots of money, you make tons of money, which is what casinos do and exactly what Renaissance technologies did. So yes, 75 and 80% of trades are algorithmic. But that doesn't mean that they're all profitable. And yes, it's good to realize that, because that's what you're up against. You know, you're up against supercomputers. Pretty soon we're going to be up against AI generated computers. You know, how much can a human compete against that? Okay, so let's go back. I can catch some more questions later. So is there any hope for us? Yes, there's hope for us. Recognize, though, that you're not going to change your behavior. You can work around it. You can mitigate it. You can avoid it. But you're not going to change your brain process, the way people think. You're not going to change what generates emotions in you. Okay. So what can we do? Well, we can recognize these things and we can understand how we individually succumb to them. You know, what is it that I do in my daily methodology of investing that hurts me the most? Okay, and then that will differ for different people. How can I work around them? How can I avoid them? Or how can I use them to my advantage? So, some tips on what you can do. Here's how we deal with some of this stuff. One thing I try to counsel people to do is to view investing as a business, not a hobby. For most of you, it's a hobby. You're not taking it as anywhere near as seriously as you would if somebody were paying you to do it. And you should, because somebody is paying you to do it. You are paying you to do it. Right? You wouldn't hire an employee who didn't live up to your expectations. Why would you hire yourself then to do that? If you really just have most of your money tucked away and, you know, in something you don't touch, and you're just sort of trading as a hobby, fine. It's a hobby. Just recognize it as such. Recognize it as a kind of a toy you play with, you know. But if you're investing for your living or for retirement income or you know, whatever other reason you're investing, and you aren't viewing it as a business, you're probably not taking it as seriously as you could. So I think that's one sort of repositioning that can make a big difference. And we can talk a little bit more about what that means here. Oops. If you were a business, you'd be tracking your expenses. You'd be tracking your time. You'd be doing a P&L. How many of you do that? Probably very few. You would be adopting some kind of formal, disciplined, and repeatable, that's an important part of it, repeatable approach to investing. Right? Because if it's not repeatable, then you're forever experimenting, and that's not a good place to be. You need something formal and something disciplined as your mainstay. Any professional, anywhere, managing funds, managing ETFs, managing family offices, managing any amount of serious investing will have all these things. They will have a formal, disciplined approach with regards to their timing, the things that they buy, their level of diversification, the amount of risk they take. And that becomes repeatable. If it's not repeatable for success, then you can never know whether or not your investing is returning luck or skill benefits to you. And the difference between luck and skill is very important in investing. We don't fully appreciate that so much of investing is random luck, random movements, random noise, and not skill. And when we think it's skill, we try to repeat it, and that's where we start going wrong. We can create benchmarks to use as a baseline. The important thing is to measure improvement, because if you aren't measuring what you're doing and measuring whether it's improving, then maybe you should be doing something else. If you can't measure it, that's a problem. Because then at the end of the year, you're going to look back and say, well, what did I do? Okay, I was up 8%. How much of that was due to your skill and how much was just bare luck? How much of it was just beta? And how much of it came from the markets themselves? If the market was up 12 and you're only up 8, you stink. Why be in it? Right? Distinguish between luck and skill that I've mentioned. Use more science. If you were hired to manage somebody's money, or if you did it as a living, you would definitely be employing whatever science you could get your hands on to construct your portfolio. You'd be looking at Sharpe ratios, volatility. You'd be looking at all kinds of economic analysis. You'd understand these things because you'd force yourself to learn that. That's what would be expected of you. Do we do this as individuals? Not so much. Not so much at all. We rely much too much on intuition more than science. And, you know, science is difficult. It can be expensive. It requires some knowledge and maybe some training. But it's important, and it may return quite a bit of benefit for that training. What else can we do? Another thing I suggest to people, and this doesn't have to be forever, I think it's really good to do it for a while though, is keep a decision journal. What does that mean? That means you already have a record of what you buy and sell, when you did it, and whether it makes any money or not. What you don't have is a column called rationale. And somewhere you should keep a spreadsheet and put it in there, which is, why did I buy this? What was I thinking? And do it right after you buy it, so it's fresh in your mind. Why did I buy this? Because later on you're going to be biased by its performance. So right at the time you buy something, why did I buy this? Saw it in the media, friend mentioned it, news, earnings, whatever it is, get it down in writing. It will tell you an awful lot about your process and your discipline. And then you go back in a month or two and you look at these things, and you can look at that versus the performance and probably draw some really good conclusions about where you're going well and where you're not going well. There actually, in the professional world, is software that does this. And if you're a professional portfolio manager, you can avail yourself of software that will understand, because you'll program it to understand your trading philosophy and your strategy, then watch exactly what you do and flag you when you're not adhering to your own strategy. Okay, so that's keeping a decision journal, fairly easy thing, because all you're really doing is adding one piece of information. Why did I buy this? Or why did I sell this? And the only way you're going to know over time what's driving you to make these decisions is to write it down and then go look at it. Third, you can get a trading buddy for second opinions. All right. What this is basically saying is not somebody to help you trade, somebody to provide an alter ego, somebody that can give you an opposite opinion when you need one, and you need one often because you won't do it for yourself. Chances are you're going to be looking at all the good points about something, or all the points at least that you know about, and you're not going to be looking at the risks. You're not going to be entertaining the idea of, oh, this could lose money. But another person with an objective opinion can provide that. Make sure it's somebody who doesn't already own the same thing you own, because they will no longer be objective. What you're doing is essentially soliciting a dissenting opinion. You're getting a counter to your opinion. You think it ought to be bought. Find somebody who thinks it ought not to be bought, and why. Because it may be something you didn't consider or didn't think of. And so your equation was biased to begin with. There's an interesting sideline on this, and that's that the Supreme Court understands this. And the Supreme Court has a policy with every decision that they make. Some justice has to come up with a dissenting opinion. And if somebody doesn't volunteer, they assign it. And they must write up a dissenting opinion. Even if all, what is it, 8 now? Even if all of them are, and that's rarely the case, but even if all of them are on one side of an issue, totally unanimous, somebody still has to write up the dissenting opinion to kind of keep them honest. It also helps for going back later when maybe something comes up about that same issue and you want to know, well, what were some of the counter issues that we considered? But it's important. And if you solicit a dissenting opinion from someone you trust and respect, you'd be surprised at some of the information you're going to get. And it's especially good when you have one of those bet the farm moments, and it's like, oh my God, this is really an opportunity that I should jump on, with both feet. That's exactly the time when you want to call somebody and say, am I crazy here, or does this look like a great opportunity? All right, another thing you can do, and this is a biggie, limit your media exposure. Now that's hard, because we have a thirst by nature for knowledge and more information. Unfortunately, the well we go to drink at is poisoned. And that's the problem. You can get as much information as you can if you could trust it. But today you can't. Most of what we see now is either biased or sponsored. I had for years followed the Wall Street Journal. I had the utmost respect for the Wall Street Journal. Look at the opinions in the Wall Street Journal. They're completely one-sided. And that's filtering into the news side of it as well. Even if it's only subtle, like where they put something on the page for emphasis. I still read the Journal, but I read it very carefully now. Also, most of what we see is old news. It may be hours, it may be days, it may be months, but it's old. It's already been traded on. You can bet that, because trading occurs, in seconds to minutes on new news. So recognize that you read something and you think, oh, that was a really good earnings report that came out last week. I should buy that stock. But it's already going to be up. And the question is it already fully baked in or not? Also, much of what we see is hyped. The headlines are hyped for attention grabbing. because there's so much competition for our eyeballs out there. Things are overhyped. MarketWatch is terrible for that. Microsoft News is terrible for that. They put such ridiculous headlines in as to attract us. And when you read the articles, you realize, that was just hype. If you start trading on headlines, you're really going to be in trouble. Much of what we see is either totally fake, it's incorrect, it's misleading, it's biased. It's sad. It's sad what's happened to the media. The internet facilitated anybody getting out there and being media. Anybody. So, there's no accountability. You don't go back to some of these, gurus on the media and say, oh, that decision that they made last week about whether or not we should do that was wrong. Nobody ever says that, right? So it's really a reader beware kind of situation. And if you find yourself just surfing the web, looking for ideas, you're really in trouble. You really have to limit yourself to trustable media. And it's tough. You have to find something you can trust. And if you have to pay for it, you pay for it. It's not all going to be free. In fact, if you pay for it, you're likely to get something that's better. But we all have a tendency to read the free stuff. It's there. It comes across our phones and our computers. It hits us over the head. And unfortunately, it's plagued with bad stuff. What else? I think we should put more science in our process, more math, more discipline. The more math and science you put into your decisions, the less room there's going to be for your instincts and emotion to fill the gap. That's the bottom line. Investing, it is a science. Yes, it's the result of a lot of people with emotions, but it basically is a science. It's about data. And if you're a pro in any way, shape, or form, you're going to be using a lot of science and a lot of math and very little intuition. We have this, this sort of preconceived notion that traders are people that, will sit there with a phone in a big company and just watch the markets and sling money back and forth at things because they know what's going on. That doesn't exist. It may have back in the 50s and 60s last year, but last century, but not this one, right? Now it's all done by computer. And even people who are traders that are making human decisions are using the computers to help make those decisions and identify the opportunities. It's all done by computer. And so it's science, it's discipline. They know it. Unfortunately, we all don't. Diversify. That's getting back to the fact that I mentioned earlier about 20 plus positions. That will reduce about 85% of individual stock risk. I know it's tough because you can't always own 20 or 30 different positions. It would be a lot of money. Figure out a way to get around that. Buy some ETFs. You could buy call options on some stocks instead of the stock itself and end up paying a fraction, 20, 30%, maybe 10% of the value of the stock with very little time premium if you're going deep in the money. I use that as one way to diversify myself. And understand, basic risk reward is not necessarily rocket science. It's just that we don't tend to focus on the risk enough. We don't tend to focus on what normal beta means. Beta means both directions. And we have too much confidence in ourselves and in our picks to think that we might end up buying a Silicon Valley bank and, oh my God, look what happened. If we buy one bank, we should be buying 5, and we should be spreading that into, 20 or 30 or 40 different positions, but we tend not to. Be careful with charts. Okay, this is kind of the last section. I love charts. I've been a technician since day one. I used to be one of those guys that bought the charts that came out weekly. And I wouldn't trade toward the end of the week because I knew over the weekend or Monday, I'd be getting the new chart book and I'd start trading again. I love charts, and it was charts that got me into behavior, because I would follow charts and I would look at what's going on, and I would have this driving urge to want to understand what behavior is driving this move. What am I looking at when I look at this chart pattern? And the standard technical analysis chart patterns that you'll see, in my opinion, are largely bogus. You know, the idea of support and resistance. Support and resistance are not flat horizontal numbers. They move up and down with the trends in the stocks. So some very basic aspects of technical analysis, I think, are more dangerous than not. But on the whole, I don't do anything without a chart, because a chart is how I get the big picture. I don't care what news I look at or what earnings I'm expecting, or whatever reason I'm going to buy a stock for. If I don't look at a chart, I won't buy it. The problems are our brain misinterprets charts. It looks for patterns where they don't exist. It'll try to complete a pattern where it does so just out of its own creativity. We don't use enough data points. If we use a chart that goes back a year or two, we're using enough data points. There's enough data there. If we're just using a week worth of memory, we're not getting enough data. So let me talk about what I do with charts. I use 4 charts. I mean, besides looking at an individual stock that I'm looking to trade, I use 4 charts to develop my big picture. And I use them religiously. All right. There's 2 15-minute charts and 2 daily charts. And it's basically just SPY and the Qs, because both of the instruments are tradable, so I can actually trade it if I want to, which I do. And secondly, I get a 3-month span and a 2-year span of time. So 3 months is what I consider relatively short term, the 2 years, the longer term. And that gives me the big picture. That's all I need. So here's the current example of the SPY 15-minute chart. And I have a methodology that I use, that I invented for myself, of drawing trend lines around the trends. And by doing that, I get the big picture. Okay. So this is the short term. This is basically what's happened, in the past couple of months. All right. We had the big January run. Oops, how did I lose that? Okay. We had the big January run, and we've been correcting off of that. And most of these, well, pretty much all trends end up being able to be described by parallel lines, with a couple of exceptions. But the parallel lines encompass the entire trend and give you a sense of, are we still moving up, or are we now moving down, which is the bottom line you want to know. So at the end of January, beginning of February, we broke the uptrend line for that big January move, and we've been correcting since. And so, yes, we've had up moves in there. We had one at the beginning of March, which was, a couple days really strong, but it's within a downtrend. And so by knowing that, you tend not to get sucked into thinking, oh, everything's good now, we're going to the moon, and end up getting whomped like you would have this past week. So that's my 15-minute chart. Here's the daily. This is kind of an unusual situation where the lines are not parallel, but they do encompass all of the move. And occasionally you will see this kind of a pattern in the long-term chart where the lines are not parallel. But this really tells me the big picture, that in October, we had a bottom. We're nowhere near close to it. We had, a really nice move off that bottom. We corrected another nice move in January, nice parallel trend here, and we broke that downtrend somewhere up here in January, to the point where it gave me the confidence that we're now in an uptrend. October's a good low for now, and you can go long. But even within any trend, you get counter trend moves constantly. And so you have to know, okay, was this move this past week trend or counter trend? That's important to trading. Well, so far we came down, and we came down just a little bit below the line I have drawn here. And the line may not be exactly where I've drawn it. I may have to change it, but I at least have some sort of picture here. There's a good chance we can start bouncing next week and stay in this uptrend off of the original October low. If not, then it's not looking good. And it's looking, any break at all here this next week will indicate to me, we might be going down to retest. That's an important big picture item. And I usually look at the moving average convergence divergence to get a little bit more on the picture of, are we heading down, or are we heading up? Okay, so that's SPY. I do the same thing for the Qs. And here's the Q short term. Definitely still in the downtrend, correcting off of the January move, but the January move was stronger for the Qs than it was for the S&P. But we're still heading down. This doesn't necessarily look like the bottom yet. And momentum down here, the MACD is pretty negative. But when I look at the long-term Qs, you had a big long decline, which really, seesawed just like you would want it to or expect it to, all the way down last year, bottomed in October. It's moving up. We are still in the uptrend off last October's low. We could come down here and touch this lower line, which I suspect is very likely to happen, and bounce off it and remain in this uptrend. That line will determine whether or not we are going up or we break. Now, these are my lines. This is not standard technical analysis. I developed this stuff. If you want to take a look at it, I talk about it in my book, which I'll mention later. But you can develop your own system. The point is, have something that you can rely on that gives you a discipline for understanding what is the big picture here. Where are we generally headed, and it gets you away from the day-to-day, oh my God, we went up today, we must be going up again kind of thinking, which is, you cannot from any of these. I mean, look at all the daily moves back and forth. You can't tell from a daily move, even a weekly move, what's really happening, because all those counter trend moves obfuscate the real trend.
Rick, quick question on the chart.
Yeah.
The MACD on the chart, how do you use it, or do you use it?
I do use it, particularly on the long term here, because you'll notice once your black line crosses the red up, you're generally in an uptrend. And when it crosses down, you're generally in a downtrend. It's good for confirmation. I mean, follow all these moves back. If you had been, generally just trading MACD crosses is a pretty good overall trading strategy to keep you in trend. So yeah, I like it. So let me finish out and then we can take some questions. Where do you go from here? I would suggest there are lots of good books, and I'll give you a list of a few of them here on behavioral finance, just to understand how it works and what it does. And you'll get a lot of the things that I gave you with a lot more examples from any number of authors. There are a lot of good books, and they're very readable. Good idea to start a decision journal because it will give you some big clues on why you make the decisions you make. Think about yourself more as a business than as an individual, and what would you do differently? If you were being paid by some third party to manage your investments, what would you do differently? Get and try to keep on a regular basis a big picture perspective somehow. I use the charts. Maybe there's other ways you can do it, or other chart techniques you can use. But I think it's always helpful to have something that brings you back to the big picture, so you have a sense of what's going on. And you can't get the big picture by reading the headlines. You will get very mislaid by doing that. Find a trading buddy for sanity checks. Adopt some discipline and add some science. You know, these I think are the key things to getting around and avoiding and mitigating the biases. And if you can recapture, you know, somewhere between 3 and 6% a year that we suffer from the market performance by doing these things, think about how much that's worth to you. You know, put that, you can make dollars and cents out of that. So here are some books. I assume you'll get the copy of the slides if you want, so you can go back and look at these. This is just a handful. There are about 150 listed on the behavioralfinance.com site. But these are some of the more popular ones. They're all different. So Dan Ariely, funny guy, predictably irrational, was just kind of a bunch of funny stories, not necessarily all about finance, but behavioral science applies to lots of things other than finance. Two in the middle there by Dan Crosby, The Laws of Wealth and the Behavioral Investor. He's a real up and comer. He's in the business. He serves as a kind of a chief behavioral officer for, I believe, a big wealth management firm. So he's kind of a rare duck. Dan Kahneman's Thinking Fast and Slow. Kahneman was one of the people who was behind prospect theory, really one of the fathers of the movement. Thinking Fast and Slow talks a lot about psychology and a lot about what it means to have all these subliminal biases in understandable terms. Finance for Normal People, essentially a textbook. Mayor Statman is a Santa Clara professor. He wrote that essentially to be a textbook because there really isn't a textbook other than that in the field. Michael Lewis wrote The Undoing Project. Michael Lewis is a great writer, and The Undoing Project about the whole movement behind behavioral science, about Kahneman and Tversky and how they developed all their thinking, and about how it's being used elsewhere, like in sports. His whole first several chapters has to do with behavioral science in sports, like basketball. Psychology of Money, one of the most recent ones by Morgan Housel. And another one on the fringe that I really enjoyed was Subliminal. There were so many things in that book that I just was unaware of and which really kind of blew my mind. Leonard Bolano is actually a physicist by nature, worked with Stephen Hawking, but wrote a couple of books. And one of them was Subliminal, not necessarily focused on finance, but just focused on all the things our unconscious mind does that rule behavior. Very interesting, very entertaining. So a smattering there of different books you can pick up on the subject. Here's my contact information. That's my book. I didn't put my book on the list because it's out of print. I still have some copies if anybody really wants one. What my book does is it gives you basics of behavioral finance, and then it relates it to technical analysis. So if you really are a chartist, if you're into looking at the charts and using them to trade, this is the only book on behavioral finance that does that. Um, and I'm happy to share that. I still have some copies at cost, so just let me know if you're interested. And at this point, let's see, let's leave that up there and let me go to the chat to see what else came in. Could I explain the MACD on the chart? The MACD is the bottom part of this chart here. And it's a moving, it has two moving averages, a slower one and a faster one. And, the idea is when the faster one crosses the slower one, it suggests a bit of a trend change above in the actual prices. And if you look at what happened when any of these lines crossed, I mean, you do get some things like down here on the left where it's a real jumble and it doesn't tell you anything. But this period like last March, where you have a nice rising, quick moving average over the longer moving average, it described a big up move in the market and was parallel to that. And when it crossed back down, did exactly the opposite. Now it's below the red line. You had a big long decline. It's not a bad way to keep the big picture of whether we're in an uptrend or a downtrend. It's not as if, on the day it crosses, that's the absolute ideal day to trade necessarily, but it definitely keeps you aware of what the trends are. And when you see this crisscrossing stuff like this, there is no trend. You just have a lot of garbage. Have I read any Duke's books? No, I haven't. So sorry, I can't give you an opinion on that. Can I identify data or measures to evaluate risk? I kind of evaluate risk visually by looking at the charts. From the standpoint of statistics, you look at Sharpe ratios, and there are some various, other types of ratios like that, which tells you, how much move you get for the amount of risk. But I do it visually. I mean, I look at where has a stock been, how much does it move up and down. If you know the volatility of the stock, the historic volatility, that's a good measure of risk. The volatility on the market itself, runs about high teens, low 20s. So maybe 18%, 19%. Recognize, by the way, that volatility changes over time. It's not fixed. But each stock has a volatility also, which is a good measure, and particularly a good one against the market, of how much risk is there in this stock, because volatility, like beta, means it can go both ways. If you have a stock that's got a 50% volatility, it's essentially saying that the stock has the capability to move up or down 50% in the next 12 months. That's good to know. That's, a lot different than one that has 20% or one that has 120%. Let's see. SVB, any knowledge of how large of a short position was held prior to default? Also, who were the primary voices calling out fire? I don't know about short position. I didn't look at that. The only thing I've read so far about the voices was Peter Thiel, who most of you should be aware of, has a large venture capital community, and he sent out something that told everybody that, like the day of or the morning of, to get out of Silicon Valley Bank. I don't know yet where he got that information or why. I mean, he's certainly tapped in. But he went out to his whole community, which is quite a few startups, and he said, if you're with Silicon Valley, get out. I'm sure more stuff will come out. on the story, however, and maybe there's other people besides Peter Thiel who were involved. Value line is a good second opinion before buying a stock and a good second source. That's fine. Sometimes I'll use Seeking Alpha, and I put articles on Seeking Alpha, by the way, if you want to follow mine. I find Seeking Alpha interesting in that it's not professional, but they do tell you on Seeking Alpha what the Seeking Alpha authors think about stock versus what the professionals think, which is also good to know. I find that people on Seeking Alpha a little bit more objective, actually. They don't have an axe to grind because they're not working for a big firm. They're spending their own money. Software tools for investing. I don't use a lot of software. I trade options. So I use an option tool that does all my like what ifs and strategy calculations and all of that. Other than that, I don't use software to trade. Now I do use software to get information. I'll check Seeking Alpha. I'll check various things. But most of what I do now is option trading, and the option trading it's kind of different than stock trading. I'm not taking speculative positions with options necessarily. I do a lot of just hedging stuff. So I'll do strategies that capture time value as opposed to in option strategies that bet on a direction. And there's definitely software and things you can follow on that sense. Let's see, there's a couple of new ones here. Any opinion of Kramer's encouragement to use discipline and diversification and index funds? That part of Kramer's advice is actually probably good. I find it just totally humorous that, this guy comes out as a guru on the media, and the professionals actually created an ETF that follows him and an ETF that does the opposite. The opposite Kramer. I mean, that's just hilarious. We'll see where that goes. But anybody who takes that stuff on is taking on something that was done for a laugh. What is the blue? I guess you're talking about my charts. I use blue for uptrends and red for downtrends, if that's what you're referring to. Is there...
and possibly the volume bars at the bottom.
Oh, the volume at the bottom. Well, the volume is, those kind of faded red and black bars at the bottom of the chart. They're not blue. To be honest, I don't follow volume much. I have it on there because occasionally when there's a really big move, and it's sort of climactic, one way or the other, I find it helpful to know whether it was a very low volume day or whether it was a very high volume day. Other than that, I don't pay a lot of attention to the volume.
Yeah, I think someone piped in and said the blue in the MACD is the difference in the MACD lines.
Oh yeah, it's the blue bars down there at the bottom are just the difference between. It's a different way of looking at the two lines. The difference between them. And you see how it's like every market movement. It's a sine wave. And it's always going to be a sine wave. Now, the waves are not the same length all the time. They're not the same height all the time. But the market is one big sine wave. And it has been since inception. And it will continue to be. And, 100 years ago, the Dow theory started to talk about that. I mean, so we've known it for a very, very, very long time. If you lose track of the fact that the market is a sine wave, you really lose track of the basic nature of market trading and market movements, because they're always going to be in some sort of a sine wave. that's the nature of auction trading, and that's the result of the way our market processes work. You end up with a seesaw action on a continual basis, going from, ebb to flow, from positive to negative. A lot of Prechter's work had to do with that. And my work has to do with that. There's no question that if you lose track of the fact that it's a sine wave, you begin to project things way up further and way down lower than they're ever going to get to. It doesn't mean you still can't have big moves, but you have big moves in the context of these longer trends, one way or the other. And the trends are all going to be different. So if you look at the trend on this QQQ daily chart, for example, on the downtrend last year, it was pretty wide. I mean, that's a pretty good spread from bottom to top. 267 up to 333. That's, like 60, it's like 25% maybe in rough order of magnitude. That's pretty big that's an inside trend. That isn't even the big trend. That's just a counter trend move inside it. The whole trend, can be even bigger. That keeps you grounded in how big these moves can be relative to where the indexes are. And then within the moves, you're always going to get counter trend moves. And what's important is understanding whether it's trend or counter trend. Right now, my charts say we're in a counter trend move that's coming down off this 313.68 high in early Feb. And we haven't bottomed yet. We could, it doesn't have to come all the way down to the line. The market could turn, and start running up Monday. But given the way things are, I don't suspect that's going to happen. And the big question is this dotted line down here going to hold? And that's the question, because when that one breaks, that means this whole trend from October to now will be over and we'll be in another downtrend, and that will not be good. That will indicate that we're going to have a pretty tough late spring into early summer. Now, my personal feeling, eventually, unless we see more Silicon Bank surprises, the economy is too strong for us to let the market really collapse here. That the October low really built in a lot of the weakness that it needed to build in, because remember, the market's a very anticipatory beast. And the same thing will happen with the recession. And I wrote an article on that in Seeking Alpha, that recessions bottom way long ahead of where the recession bottoms. I mean, the market bottoms way ahead of the recession. Sometimes the recession is so well anticipated, the market can bottom before we even go into the recession. So you got to remember how much of an anticipatory animal the markets are, and how they're building in things for the next 3 to 6 months. So yeah, we don't know when that recession's coming. So the market is really kind of marking some time, although it still trends. And that's just good big picture to keep in mind. Whether you're long or whether you're short, and whether you're playing the big long moves for the year, or whether you're playing these short counter trend moves for swing trades. In my case, I'm trading the options, so I know when to be in calls, when to be in puts. So any other questions? Anybody want to blurt out anything verbally? Up to you.
So I think we've reached our time for today. Lynn, did you want us to wrap us up?
Yes, I wanted to thank Rich for an excellent presentation, certainly food for thought. And just to remind everybody that we'll be back on May 13th with a program. And I really like the format of 2 speakers, because it gives us a lot of material, a lot to think about in terms of the meeting. So thank you all for attending. And we appreciate your support, and we wish you all good luck in your investing and in your lives. And so we'll sign off.